Hi, my name's Roger Schluter. This video is actually about hard money loans, and I don't know if most people really know about them. I learned about them in banking when we were doing a lot of fix and flip type projects where the borrower would buy the property and then they'd borrow the money. Usually they'd have something down, but they would go ahead and borrow the money for the property and then for the fix to fix the property up, and then they would turn around and sell it and pay us back and then get their profit out of that. So anyway, hard money loans are usually used in the real estate industry, and they are asset-based loans that sometimes can be a loan of last resort. By asset-based, I mean they value it on the value of the collateral. Like if they're doing a loan on a real estate, they're valuing it on that real estate, the value of that real estate. So anyway, the loan to value is less than conventional real estate loans. So the lender will usually only lend like 50%, 70% of an asset's value. The interest is usually high, and the loan term is usually also very short. So these things don't really go together to make it easy to pay off a loan. These loans are heavily used in the real estate industry, basically in the fix and flip real estate transactions. And you find companies that do it, but you find a lot of individuals that do it also. And what they do, usually when the individuals do it, they only want to loan like 50% on a property. And then they will go ahead and take a lien on that. And then if you miss a payment, they just foreclose on it. And then they just go down the road. And usually they try to do only 50% because they feel like they can sell that property and get that money out and get that out of it. Anyway, please subscribe and hit the bell icon for notification of future videos. Also like and share the video, please. The following are examples of a typical hard money lender and a conventional lender. Timing. The conventional lender can take from 30 to 60 days to close. The hard money lender will close a loan in 3 days to 1 week. You can get your money a lot quicker. The hard money lender is basing this loan on the value of the asset, not usually the credit worthiness of the borrower. So if you don't have that great of credit, you can still get money from a hard money lender. And they are going to go ahead and usually base it on, probably like 50% of what the property's worth. And if you miss any payments, boom, they're going to take it. So anyway, credit. The conventional lender is lending to the borrower for up to 30 years. So they're very concerned with the borrower having good credit. The hard money lender, on the other hand, is basing their loan on the value of the collateral. And they usually only lend from 6 months to a year, sometimes go up to 2 years. So they're good. I mean, they don't have to worry about the credit as much because they're not going to have the loan that long. Anyway, the interest rate. A conventional lender is concerned about competition in the marketplace. And will they price their loans accordingly? Bankers usually base their loans on the prime rate and lend it from 1 to 3% above the prime rate. Hard money lenders are taking more risk and therefore are charging up to 15 to 20% when the conventional lender is lending in the single digits. So I mean, it's high interest, it's quick payback, and it's low loan to value. So anyway, it's not the best of all worlds, and that's why these things are a lot of times loans of last resort. If a guy can't go anywhere else and he does that type of thing, that fix and flip type, he's got to go to a hard money lender if he can't go to anybody else. Loan terms. Conventional lender is lending for up to 30 years, like I said, on real estate. Hard money lender is taking on more risk, so the terms will be shorter. Most hard money lenders are usually 6 months to 1 year, occasionally lending 2 years. Fees that the hard money lender may charge are numerous. He can charge a broker fee, he could charge an origination fee, an application fee, an underwriting fee, a doc prep fee, a processing fee, a funding fee. And this is not a full complete list. I mean, usually the fees will be included in a loan for limited out-of-pocket costs, but I mean, I'm telling you, you need to ask him to give you all the fees before you sign on the dotted line. Typical deals financed with hard money, usually, like I said, a fix and flip where the real estate is usually run down, needs repair, and the hard money lender may lend up to a percentage of the value after the improvements are made. The borrower will fix the property and then sell the property to pay off the hard money lender, and any profit then left over goes to the borrower. Two, sometimes they'll do a refinance. The real estate is purchased, renovated, rented under hard money, and then the borrower refinances the loan with a conventional lender. This is a cost-effective way to really acquire real estate, rental real estate, because you're basically you're buying it with the hard money lender, you're renovating it, and then you're renting it, and then you're turning it around and refinancing it and paying off your hard money lender, and then you have left your conventional loan, which is usually going to be a lot better terms and conditions. So let's run down the pros and cons of hard money loans. Hard money pros: faster approval for borrower, more flexibility in the loan requirements, including underwriting. Approval based on the collateral, not the borrower's credit score. That's a big one. And then hard money cons: riskier than the traditional bank loan, large down payments, high interest rates, and then shorter terms of usually less than or equal to 1 year. Sometimes they'll go up to 2 years. And then sometimes they'll even require a track record of successful projects that you've completed. They want to know this because they don't want to waste their time. Hard money lenders are usually less forgiving than your community bank down the street, and they will not flinch if they need to foreclose on your property. Banks will usually seek a resolution, but hard money lenders, man, they're in it. They're just going to go ahead and take that property, turn around and sell it. And so anyway, they're pretty much unforgiving. So anyway, please subscribe and hit the bell notification for future videos, especially if you like this kind of content. And like and share if you found it helpful. My name is Roger Schlueter, and I will see you in the next video. Thanks.